You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is real estate expert Alan Schnurr. Now, Alan is a real estate investor based in Houston who currently specializes in value-add anchored retail centers throughout the U.S. Now, over the years, he has put together an impressive real estate portfolio, which has consisted of more than 2,000 apartment units, hundreds of single-family houses, self-storage investments, industrial, and his favorite today, which is retail shopping centers. And so, guys, with that, I'm excited to get onto the show with Alan and learn about everything that he's got going on today in the retail space. But before we do, I have a few quick housekeeping items I'd like to run through. Like I do every week, I like to go through my one personal and one professional best of the prior week. Well, starting off with the personal best. We just wrapped up our annual 3-day, 280-mile charity bike ride to Key West, and it was a huge success. Riders from all across the country, they came and they conquered, man. And best yet, we'll end up positively impacting thousands of deserving families and children this holiday season. And, speaking to the event itself, the weather was much cooler this year than prior years, but with that cool weather came headwinds, and the headwinds were very strong, which made for a very physically and mentally challenging ride, especially for the first 2 days. It was somewhat brutal, okay? But overall, it was an absolute blast and equally rewarding, again, because we just are going to touch so many families and benefit so many families as a direct result of this event. And the best part is I get to mix and blend my two favorite passions, which number one is cycling and number two is giving back. And so I get to do that each and every year. This is an event, again, I started 9 years ago. It was an idea. As like us entrepreneurs, we have these ideas and then we execute on them, and a lot of times they turn into really cool things, okay? That's exactly what happened here with this event. I started it 9 years ago. The very first ride, we literally raised a measly, I think, $400 for the charity, and there was 9 of us that rode the event. Now we max it out every year. We basically have a waiting list. We limit it to 75 riders, so it's very much a boutique event, and we sell out each and every year and always have a waiting list. On average, we'll donate anywhere between $40,000 and $50,000 each and every year to the different charities that we support. So it's a wonderful thing. Moving on to the professional best. Now, not only did the office not burn down while I was away at the bike ride at the charity event, but my partner Brian and I, we came back to things being in even better shape than when we left, which is all about having a great culture wrapped around support and just really being there for one another. And so it was just good to go away, not think about the office and work, and just really focus on the road and making great friends and again, riding our butts off to support these just wonderful charities that we have been supporting here for many years. So moving on, guys, if you love what we're doing here at the Real Estate Investing for Cash Flow podcast, take a moment, go subscribe to this show. That way you're notified as soon as we come out with a new episode. In addition to that, if you haven't done so already, and it only takes a minute to do it, go leave a review and rating on iTunes. This really is the lifeblood of this show, okay? Whether you know it or not, it really is. We look to have these reviews to attract new awesome guests to the show. It also helps us go up in the rankings on iTunes when we have reviews. It shows that people are listening and they like the content that we're putting out there. So please, think of it as a Christmas gift. We're going into the holidays here. Go to iTunes if you haven't done so already. Leave that honest review and rating. And like I do every week, I like to actually give a shout out to one of the folks who has taken the time to leave a review. And so this review is from screen name Buffalo Pod 16. Yeah, Buffalo Pod 16. These screen names are so goofy sometimes. And they say, Kevin's energy makes it easy to binge listen, which I do. His knowledge and experience, as well as his open mind and willingness to constantly try and learn more from the variety of guests, makes his podcast invaluable. Highly recommended. Well, I really appreciate that. Thank you so much for leaving that review. And moving on here, guys, last thing before we get on to the show with Alan, I want to remind you of the free 30-minute phone call that I offer each and every week. This is a way for you to get on the phone with me for 30 minutes, uninterrupted time, focused time, to where we can talk about everything and anything your heart desires about real estate investing. Go to my website, kevinbupp.com, schedule that call with me. No cost, no ulterior motives here. Just time for you and I to get together and get to know one another, and hopefully where I can add some value to you and your business. Again, go to kevinbupp.com to get signed up for that call. And now, without further ado, I'd like to get on to the part of the show that you have been waiting for, which is our interview with Alan Schnurr. So here we go. Alrighty, guys, it is my honor to introduce my guest for today's show, commercial real estate expert, Alan Schnurr. Alan, how you doing today, my friend?
Hey, Kevin, thanks for having me. Looking forward to this.
Yeah, no, absolutely. Me too. And, I've been following you for some time on Facebook. See all the great action videos that you take out at your different properties. I know that you're hot and heavy in the retail space, and you've got a few other concepts as well that we're going to dive in today. I'm not going to spoil the little secret that we're going to talk about here. It's another little sub niche of your business. And so with that, I'm real excited to just dive in and learn a little bit more about you, your background, your business, and all the great things that you have going on. And so first and foremost, for those folks that aren't familiar with you, that don't know who you are or what it is you do, maybe give us a little bit of a background of yourself and ultimately what led you into the real estate space.
Sure, Kevin. So the story really begins, I find myself working in the World Trade Center on the 101st floor. And I was fortunate enough to have left on a business trip on September 10th, 2001, 12 hours right before the attacks hit. And we really get hit hard. The company I worked for lost 700 out of 1,000 employees. And I had lost 40 out of 44 teammates in my division.
Wow.
So I found myself in Portland I'm a New Yorker, and I spent a week by myself. And that week I made a lot of changes in my life. I just kind of faced all my demons. I created new plans for myself. And I was always an entrepreneur, but I found myself in corporate America. And that was the week where I just said, I've had enough. And I really just got my ass kicked. I had to start all over. And I was going to start building my businesses. And that's exactly what I did over the following months after that tragic event. I started getting involved in opening up some brokerage shops, and also the single family house market I jumped into. And that was the introduction to real estate for me. I started going to the clubs, listening to the podcasts, going to the networking meetings at night. And I became really good at buying, holding, fixing, renting single families, where over a certain amount of time, I accumulated 400 single family houses. Mm-hmm. And I more or less ran a few hundred as a rental portfolio, where I made my main source of income for a while, until I decided it was, like a lot of us, it was time to switch up and looking for an easier, more efficient way. So what do? We jump right into the apartment business, right? Mm-hmm. So over a 5-year period, every 90 days, we bought either through I created syndications, or I had one partner. We started every 90 days, we bought an apartment complex. So before I knew it, I had around 2,000 units and 400 houses. So I had a nice housing portfolio growing. But then I was getting a little burnt out on it. Things were breaking. There was just it's not so passive, is it? When you find yourself buying all this housing. So I started selling it all off. And I'm actually really excited to tell you that last week I just sold one of my last apartment complexes. I bought around 22 up to date, and I just let one go, the last one go last Friday. But over the last 2 or 3 years, I'm kind of a contrarian. I'm always looking to buy low, sell high, looking for the best value, looking for the best cap rates. Mm-hmm. And I've found that in retail, which I'm sure we're going to start talking about soon, retail shopping centers. We can start talking about the triple net lease business. I've listened to some of your podcasts, and I know recently you had someone on talking about, what is the NNN, the triple net lease retail model. And if we could just touch on it quickly, when we have these apartment buildings, things break, the owner has to fix it. Somebody skips out on their rent, the owner has to eat it. And taxes go up, the owner's responsible. And if insurance goes up, the owner's responsible. Well, I kind of had this dream one day. What if somebody else was responsible and I could still stay in the real estate business, right? So, somebody, a really good friend of mine, introduced me to shopping centers and
Hmm.
warehouses and some other triple net lease businesses where all those expenses are really the responsibility of the tenant.
Hmm.
And I was a convert. It was like a new religion for me.
Well, that's fantastic. So I am very excited to talk to you about your model in the retail space and
Right.
all the different attractor factors that took place, other than just the fact that triple net versus the structure of a multifamily or lots of other
Mm.
residential real estate, to where basically being the owner landlord, you're covering all those expenses associated with that property, the maintenance of it. But I'd love to chat with you about you got started in the early 2000s, and you essentially you worked through, you're an investor through the Great Recession. So talk to me about how your investments, in addition to that, how your investments
Right.
handled 2008, but also where were you investing at that point in time? Geographically speaking, I know that you're a New Yorker,
Right.
but you're in Texas today. You're in Houston now, and so leading up to 2008, and before the transition into retail, were you in the Northeast still, or had you already made your migration pattern down
So
to the
I worked
southern
for a
states?
company by the name of Cannon Fitzgerald, and we had a recovery office here in Houston, Texas, after 9/11 hit hard. And I came here and I worked with them for a few months, and they decided didn't want to be in the particular business that I was in, which afforded me the opportunity to go out and start my own commodity brokerage shop. So I
Okay.
decided I'd stay in Texas. One of the greatest benefits about Texas is there's no state income tax.
Hmm.
So if you want to be in a high net worth business like real estate and a highly paid W-2 K-1 employee, whatever you want to call it, there's only like 5 or 6 states in the United States where there's no state income tax.
Got
And living in New Jersey, working in New York,
it.
I mean, we were clearly above 50%. You could be making a few $100,000 a year. You're just a regular schmo.
Yeah. Yeah, no, that's
So,
unfortunate. I'm in Florida. I'm in one of those 6 states.
right,
I love
right. So,
it.
yeah, for sure. I decided to open up a commodity brokerage shop in 2001. But I also decided to start taking, I don't know if you remember Carlton Sheets, if you were around during
I
those
do.
days and
I
those
do. Yeah.
courses, and started going to like the local RIA clubs, and I was just mesmerized. Everyone's up there saying you could buy property 10, 20, 30 cents in the dollar, and I bought everything. I always raised my hand. I mean, there's no dust on my bookshelves.
I still have
Right
those
here.
old cassette tapes. I literally have those old school cassette tapes. They're like
Yeah.
yellowing now because they've been, exposed to the elements for so long.
So I'm a huge believer in education, self-development, and I'm a huge believer in always trying to learn something new and stay curious and have that, the idea every morning when you wake up, like, what am I going to take in today? What's going to be brand new? And kind of like a child. So I was able to, I had this saying, I kept my job for like 10 years after 2001. And I had this saying, get a bonus, buy a house, get a bonus, buy a house. And every month I got a bonus. And every month I bought, I guess we used to call them junkers back then. So I used to buy like a 10, 20, not 10. I used to buy like a $20,000, $30,000 house and fix it up for $5,000 or $10,000, fill it up with a tenant and refinance that. And I did that many times. And then I figured out how I could start packaging them. And then the portfolio grew to 120 houses over 10 years. And once I got that 120 under my belt, it takes me a while. I'm a little slow learner. I really started feeling comfortable with, I can really scale this now. You think 120 is enough, sounds like a big number, but this is a cash flow show. And if, there's not always a lot of cash flow left over in the single family house business. So what do? You either move on or buy more. Well, I kept buying more. So I finally got a few hundred houses, and then I said, you know what, this is ridiculous. The only reason why I wasn't jumping to the apartment business is because I couldn't be full-time. I think you can buy houses part-time and keep your job or do some other things. But if you're going to go into the apartment business and you want to be a syndicator, well, you better be, you're held responsible for a 5, 10, $15 million asset. You better really show up and not just look at the P&L once or twice a month. So that was it. I had to say goodbye to the commodity business. I built something. I sold it to my partners. I took the money I made from that business, 2010, 11 was coming around. I never really got hurt in the housing market because I was in these houses for 20, 30, 40,000 a pop.
Mm-hmm.
And I was just renting them out for $700, $800, $900 a month. So in Texas, I mean, a lot of people don't know this, but 50% of all oil refinery services go through the state of Texas within the United States. So plenty of labor, plenty of factories, plenty of petrochemical companies. Those houses that I had, I can drive to all of them. They're all in one area. So I believe you're going to build a big portfolio, try to stick to one area so you don't find yourself driving 200-300 miles a day.
Yeah.
So that's really the housing business. And I said, let me scale this. Let me scale it and get into the apartment business. And I started off slow. I think I started buying like a 32 unit. And I saw the writing on the wall. It really is true. One roof, 32 units, 32 rents, or 32 houses, 32 roofs, 32 rents. I mean,
easy decision.
Right? Easy decision, but not always easy to see, right? Because we were house people, but now I'm an apartment person after the first apartment complex. So, and then I scaled it up, like anything else, which I highly recommend. Scale if you want to grow. 32 units, 52 units, 76 units, 102 and 160 and 320. And so I always believe in like pushing the envelope. Mm-hmm. And so I got that up to around 2,000 units, and I had all this housing. And I was getting a little tired. And I think every 5 years we change within ourselves. Our ideas change, our lives change, our circumstances change, our cash flows change, or they need to change. So I needed to make more money and I wanted to do less. It's kind of a hard combination, but once you put that together and you start buying warehouses or storage or what we're going to talk, the shopping centers, it was a trifecta. It was awesome.
Yeah. I mean, so you speak to being a contrarian. The absolute definition of that, and based on where we're at today in the economic cycle and also the appetite for multifamily, you selling off all your multifamily, moving the opposite direction. I mean, that is the pure definition of a contrarian, because multifamily is by far the hottest asset class and has been for like the last 7, 8, 9 years. I mean, almost an entire decade of it. And so speak to me a little bit about that mental shift of saying, hey, I mean, I know you said dealing with the maintenance issues and this and the other. I mean, but when to be honest, when you own multiple different complexes, I mean, you've got a little bit of an infrastructure in place. It's not you getting the calls from the residents in the middle of the night with their toilets broken and things of that nature, right? So you're not being woken up with those types of calls, and so there is a property management infrastructure there. Talk to me about the shift and where that decision came from, other than just not wanting to deal with those types of items associated with residential property.
A lot of this carries over from Wall Street with me. I am contrarian by nature, and a lot of those apartment complexes that we were buying in 2009, 10, 11, 12, and even 13, so they were bought at like 15 to 20 cap rate. So as we, so the spread is getting, I call it a spread. If you could buy a 15 cap rate and sell it for a 10 cap rate, I mean, as a syndicator, you have a lot of responsibility and you have a fiduciary duty to your partners. And you got to say to yourself, gee, we have so much debt equity trapped in this deal, and this is the cash flow. And can we do better with that equity if we sold the property? And which is all syndicators and people that own apartment buildings and all real estate, we're confronted with that dilemma every day. So that was definitely one of the main drivers where I said, you know what? We bought this thing for a 20 cap. We could sell it for a 10 cap. I mean, the numbers are astronomical. We were buying stuff for 5, 10, 15,000 a door that are trading right now. I just sold something for $70,000 a door in Houston that I paid $15,000 a door for in 2010. Wow. Right. So do the math on that. And one partner, and we said, you know what? We've refinanced 3 times over the last few years, but it's time to get rid of this. So we're talking about, I like spreads. So if you can sell the 15 cap and buy a 10 cap, you're capturing, 5 points in a cap rate, and you can do a lot with that. The second reason why I like to switch things up. I like to try new things. And I know we were talking about Facebook earlier, and I'm a big I believe in taking a financial goal and matching it up with a physical goal. So right now I'm climbing the 7 peaks of the world. So I just got back from Russia, and
Like not right now, like not right as we're recording this podcast.
No, but I just got back from Mount Rainier in Washington State 2 weeks ago, which is quite challenging. But I believe in matching up all these like big goals. And for me, sometimes I like to do things new, maybe like a new workout program or a new mountain or a new asset class. So I really wanted to move into a different asset class.
So you did, you changed it up in a big way. So let's talk about the fundamentals of retail that attracted you to that space, because it's funny, the media always spins everything. I mean, no matter what it is, how good and positive it might be, like it's spun into a much more negative way. And so I mean, but generally speaking, I think the average public, or the folks that are listening to this show, that is, even if they know nothing about retail, or if they know a lot about retail, what they do know is what the media spouts all the time. That's about the threats that e-commerce places on the retail sector, and that retail is a slowly dying industry, right? And so, tell me why that's all wrong, and what ultimately attracted you to that space.
Sure. I believe in credit worthiness. All right. And I got to tell you, it was always challenging collecting all the rent that was always due to me. And I don't find those problems in the space that I'm in right now with the shopping centers. If I could just kind of ramble off some of the tenants I have, Starbucks. We'll talk about, I mean, it's nice. Starbucks sends me probably around $16,000 a month for 2 stores, or a TJ Maxx. Okay, there's 4,000 TJ Maxxes on 4 different continents in the United States. They do fantastic in bad times. They're discounters, right? And they do even better in good times. So Ross, DD's, sandwiches. We'll talk Subway, Quiznos, or Burger King, or McDonald's, or how about just the mom and pops of the neighborhood, where you never really have to worry about a chiropractor is not going online, an optometrist isn't going online, your 24-hour e-clinic is not going online. I just keep going on and on and on. And I know there's been a shift from the shopping malls and the Macy's and the JCPenney's, and that's not what we do anyway. We're not buying 50, 75,000 square foot boxes where they used to be. But when you found a lot of other ideas coming in, replacing that old business model. So, I mean, remember back in the day, we used to have to go to like a medical building to go see, to go to get a physical. But now you can literally go to a shopping center, right? You see all those ER clinics come out. And I mean, I just went to go see a cosmetic dentist next to a Starbucks. I mean, that's insane, right? That was unheard of back in the day. So, out with the old, in with the new. And, so there might have been some issues a few years ago, but you don't really see them anymore. And let's really talk about cap rates, because at the end, we're here to make money and do the best we can do for our investors. Give you an example. I recently just bought, it's a 115,000 square foot shopping center in Pasadena, Texas, $11 million. And it's anchored by Planet Fitness. And by the way, and the whole movement in the health industry, between Planet Fitness, LA Fitness, 24-hour fitness, there's 5,000 of these boxes across the United States. And it's so inexpensive to walk through their doors. Right?
Man, I have to tell you, I love the Planet Fitness model. I wish I would have bought a couple of those franchises, 8-9 years ago. I love it. I love it. It's so cheap that no one ever cancels the damn thing. Even if they don't cancel it, because it's only $10 a month, and the hassle of canceling it is not worth it.
Yeah, and I know towards the end we're going to talk about, can you imagine if you did buy that Planet Fitness franchise and you own the real estate? And I'm doing that too, but we'll talk about that towards the end. But getting back to, keeping your shopping centers full, and this recent purchase we just did, we're talking about cap rates. We're coming from I'm coming from the multifamily world after owning more than 2,000 units. And I just sold the last one at a 4.5 cap. I mean, the guy's borrowing the money at best at 3.5%. So he's only got like a 1 point spread on that. I'm a little worried for him, but what can I say? What we're doing is we're buying like an 8.5 cap deal. And we just got 3.85% from a Wall Street bank on a 10-year loan, interest only. So the cash flow is insane. You're talking about like a 4-point spread. And if we keep digging into it more, would you rather Planet Fitness? Would you rather a Japanese hibachi restaurant, a Mexican restaurant, Quest Diagnostics, haircut, doctors, a chiropractor, Dollar Tree? I mean, the names. I mean, I'm buying those leases. I'm collecting rents from those tenants. They're paying for the insurance when it goes up. They're paying for the taxes when it goes up. And they're paying for things when they break. So I'm capturing 4 bips or 400 bips, 4-point spread. And if you really do the math, let's just say I borrowed $10 million and I'm capturing 4 points. Well, that's a $400,000 spread annually just on the points. That guy buys an apartment building for $10 million and he's only capturing 1 point. Well, that's a $100,000 spread. So I'm really liking my odds with the credit tenants. They're 5-10-year leases and whatever, it's 4-1, right? It's 4-1.
I'd love to let's dig a little deeper into this particular case study that you're sharing with us. So you bought it at 8.5 cap. It's, I think you said 115,000 square feet. Give us the entire picture of this particular deal. I know it's a CMBS loan, 30-year amortization, 10-year term. I'm guessing. Is that what it was? Or
but you said 30-year amortization, 10-year loan,
10-year loan, 10-year of IO as well.
Yeah, that's what's really right. I mean, 10 years.
Yeah, that's
of
interesting.
IO. Because normally my principal pay down would probably be close to like $25,000 a month. So now I have an extra $25,000 a month to distribute to me and my partners. Someone might say, sure, what are you going to do at the end of 10 years when you haven't paid down the principal? Well, really not too worried about that because we have rent bumps on all these leases, anywhere from 1% to 3% a month. So before you know it, your net income, your gross income has moved 15 to 30% at the end of 10 years. An 8.5 cap rate isn't really that aggressive, is it? I mean, it's easy for me to compress that. Matter of fact, it came with what we call hard corner and out parcel, just land where 50,000 cars a day go by. I am able to go get a QSR, which stands for quick service restaurant, and do a land lease for 20 years. I just did one in another shopping center. Let's use this one as an example. I did a Krispy Kreme land lease on a 20-year land lease. They build the structure, they pay for everything, and they send me $8,000 a month. They send me $8,000 a month, 12 months a year, $96,000 a year, divided by 0.08, just 0.08. That's $1.2 million increase in evaluation. This is real. And this is another way how we add value to these shopping centers, just going out and finding some quick service restaurants. But sorry, go ahead.
Yeah, go ahead.
Back to, what we just did. I'm just really, really excited that I can borrow, I can get 8.5% return on these names that change they trade on the New York Stock Exchange. 75% of the shopping center have national tenants. The other 25 are the doctors, the chiropractors, and the restaurants. I get the opportunity to maybe put a gas station there, maybe put, a McDonald's, whatever it is, it's going to go. It's just a matter of time. And it's an 8.5 cap rate. So what if, imagine I compress the cap rate to a 7? I mean, why not? I mean, multifamily is trading between 3, 4, and 5, right?
Yeah, absolutely.
So I love all real estate and I'm in all real estate. I just believe that it's a matter of time before the spectrum flips and retail is going to be the darling and housing will not be. That's all. And it's happened before. So I like to play the whole spectrum. And that's why I'm very heavy right now, retail. Probably have over 1 million square feet. And I have 6 storage facilities. I know we're going to talk about the washaterias, and I have 100,000 square feet of warehouse. So, and I still have, I'm a passive investor in other apartment complexes like 55 and older and student housing. I like to do things where there's that extra advantage.
Got it. So when you say storage, you mean self-storage, correct?
Yeah, self-storage and actually boat and RV as well. Yeah.
Got it. I'd love to talk about the laundromat concept that you have. So I noticed, guys, one of Alan's Facebook posts, or maybe a few of them, I can't recall, but that you were building out a, which not what you're picturing in your mind as far as a laundromat facility. This is at least to what I saw in the pictures, a very high-end laundromat facility, very nice equipment, flat screen TVs throughout in one of his strip plazas. And so I'd love, I don't know anything else about it. And so I thought that it was very interesting to see that you were building that probably in a demographic that is not typically associated. And maybe you're going to correct me because I could be wrong. I have been before. Most people associate like laundromats in a lower end income demographic. And so again, I want to hear from you about the concept, who you're serving, who your client base is there, and all the above.
So. Let's talk about the retail shopping centers and what I look for. So and before we put the washateria in, so the traffic count's important, right? So we like 30, 40, 50,000 cars going by every day. They can see the center and they can see the washateria. The demographics is important as well. I mean, let's face it. You don't want to put a washateria in the middle of an upscale neighborhood because everyone has a washing machine and dryer in their house. So the shopping centers that I would put that in is more of your C, maybe C plus demographic. Okay. I call them dollar rents, right? So we can either rent something out for $1 in the apartment business, or if it's 2 or 3, it's probably closer to a B or maybe even new construction. So we need to be around dollar rents in those types of areas where people don't own the machines. But there is a caveat to this. Guys like you might just, want to drop their stuff off, right? Yeah. So there's a whole wash, fold, and dry aspect to this business as well. So it does aim more to, how should we say this, a lower demographic, because they don't have washers and dryers, and people that live in apartment buildings, we try to set up by. But there is that upscale touch where maybe somebody wants to drop off their dry cleaning and have their laundry done as well.
Is there a certain age range of apartment complexes where it wasn't common for them to create spaces for washer and dryer machines? I mean, so like you look at like 70 and earlier era apartment complexes, like just assume that majority of those probably don't have room or never did have room for a washer dryer hookup. Is that? I mean, because how do you determine who has a washer and dryer and who doesn't, right? Even whether it's a $35,000 median income or it's a $80,000 median income, how do you make that determination and build a business based on some assumptions like that?
So we might actually go and shop those apartment complexes in the area just to make sure, or just call them. But if you're coming from the 1970s or borderline 1980s. There's a good chance there's no infrastructure and there never will be. I mean, we've all thought about this, and it gets messy when you want to start changing the whole circuit box of an apartment unit just to make room for an extra breaker so you can bring in something like that. It's expensive, the wiring. So it's not easy to convert, but I know, it's just not easy to convert. But so here's what's really interesting. And we're taking this concept and we're putting it into our own real estate. So say you have a 5,000 square foot vacant storefront in your shopping center, and I want to set up, I just did. So this is College Station, okay, in College Station, Texas. It's 2 miles away from Texas A&M, 62,000 college students. All right. It's a 5,000 square foot storefront that I took. Call it dollar rents. So I'm paying $5,000 a month rent. All right. And then I got to add in the triple net. So just call that $3, $5.15. So 5,000 times 12, we're going to be $60,000 a year in rent, and another $15,000 for the triple nets. So $75,000. Okay. I'm picking up my calculator. Give me the benefit of the doubt, and we'll call it an 8 cap. It's not, I mean, say I can sell my shopping center at an 8 cap. I get $75,000 in income, and I'm dividing it by an 8 cap. Can you guys see that number? Do you see that number? So that's just for me and my partners.
There we go. Yep.
Right. So
yep. Guys, for those folks that are listening to the audio version, it's damn near $1 million. Is what.
Damn near $1 million. I'll take that. Yeah. So that's just. If you're in my syndication, you should want me to put a washateria in, right? It's at my expense. So so it's a win-win, right? So I'm increasing the value of the shopping center. If I sell it, I've just made $1 million of value, and I'm entering into a business on the other side of the formula here that we believe returns 30% ROI.
Yeah, let's talk about the business side of it. Yeah, washateria itself.
Sure.
So the build out costs. What are we looking at for 5,000 square foot build out? Is that a $500,000 build out or more?
That's good. What we're coming up with lately, because we're really doing high end, kind of like cafe style stainless steel machines, 100-gallon machines. Check this out, Kevin. We just created a store. It's cashless. Everyone thinks of quarters and washaterias, right? The student's going to walk up to the washing machine with their iPhone. Yep. They're going to scan in the bar, and that's it. All the transactions done. They're going to go next door, and they're going to get beer and pizza, and they're going to drink too much beer, and then the machine's going to send a text saying your wash is up. Stop drinking and put it in the dryer.
That's good stuff. I love it. Does it lock the machine as well so no one can come in and steal their stuff while they're getting
No. Drink it. Listen, Kevin, drink at your own risk.
Drink at your own risk.
But so you know what? It's coming in close to around $200 a foot, approximately, and that's for the machine and the build out. All right, so 5,000 square feet. It's like $1 million.
Yeah,
$1 million. But you know, there's ways of doing it. You know, I'm not writing a check for $1 million. We're all savvy business people here, and I'm getting a bank loan. So, and banks love to finance equipment.
SBA or?
Sure. I mean, I don't do SBA because I don't have to, but SBA they love that stuff.
Yeah. Yeah. Very interesting. So talk about like the staffing requirements. You don't have anything. You obviously probably someone that comes in and clean facility.
I wish, actually. I found myself back in the service business again. And
that's right. You've got the folding. You got the laundry by the pound aspect of it. So you've got actually physical people there.
You can either drop off 20 pounds and do your own for $4, or we'll charge you, $20 for wash, fold, and dry. I mean, I hope you just drop it off, because my people are there anyway. We have a saying: if you can lean, you can clean.
Good deal. So what is the long-term plan with Washateria? Is it a scalable business? Is it something that you're going to put into your other shopping centers or franchise?
I don't know if you guys listen to you ever listen to Dan Sullivan? He's got this saying, the who what, and the who is who's going to run your business, and then what are you going to do? Something like that. So me and my business partner, Adam, we just went out and we hired a gentleman who was working for the manufacturer of the machines, was running 10 of their washaterias for them. And before that, he was running 25 Dollar Tree stores. So we've given him a piece of the business. We've totally incentivized him. We've set some lofty goals, and we're shooting for 100 stores. And I'm also shooting for 100 retail shopping centers as well. Right? I just did the math. What do we say? $1 million? If I could put a 5,000 square foot washateria in 100 stores, what is that? $100 million?
It's an attractive number.
Yeah.
It's an attractive number.
Yeah. And that's just, I mean, listen, my love is really the shopping centers and the retail and the real estate and the triple net leasing business and the syndication. You know, the washateria stuff,
it's always nice to have multiple streams of income, right? I mean, have multiple things working for you simultaneously. So I want to talk about the, the retail side. I want to make sure that we don't miss out on a few points I want to cover here. We talked about all the great aspects of retail and why you love it so much, but from a SWOT analysis perspective, what are we know what the strengths are, but we don't know what the threats or the weaknesses are. We got the strengths and the opportunities down packed. I think, we talked about a lot of those, but what realistically, what are the things that, if there's anything that keeps you up at night regarding, that particular asset class, what is it? Or what could be those threats coming down the pike in the future that maybe they don't keep you up, but like they're worth considering, right? You've got to, right? There's risk associated with any different type of investment. What are they here?
So look, when we go into a shopping center, we really like the credit. We like a mix of national, regional, and local businesses. We feel like we're spreading out the risk just enough. Sure, we have to worry that TJ Maxx doesn't go out of business. If they did, what would we do? So I'm thinking they probably have around like 35,000 square feet in one shopping center. All right. So we try to limit our downsides when we're buying a shopping center. Like we just looked at a deal and half of it was a huge entertainment center. That's kind of scary because if that entertainment center goes under, now you're 50% vacant. So, it's nice to have a plan B in life, right? Mm-hmm. We all, especially coming from the real estate business, what's your plan B if you can't sell it for this price, or what are you going to do if it goes vacant? And, the bigger we get, the more reach we have with leasing brokers and the more connections we have with tenant brokers that represent other kind of tenants from the Starbucks to the Subways. So, look, the biggest fear about retail is what happens if your tenant goes out of business. And I hear that all the time. I don't hear it all the time, but I first say in Houston, it's a national average of like 1 or 2 turns every 12 months for every single apartment unit. You're going to lose your tenant once or twice a year. And I know this because I also managed 7,000 apartment units. Mm-hmm. So you have turnover there. What do you do about the turnover in the retail? And you go get the next tenant. That's all there is to it. Or you come up with the next business idea. Or, we just replaced Lifeway Christian store. There's like 100 of them in the United States.
They just went bankrupt, didn't they?
I'm not sure, but they're not with us anymore. Right. And it's kind of like, I guess if you go get that stuff online, right? Watch Joel Osteen and TJ Jakes all day long. Why would you go to Lifeway Christian? So, but we just replaced them with, it's kind of interesting. They sent us a check so they can buy out of their lease because they're going to go the online model, and they don't want to, they're responsible. So we made a deal with them. They sent us a check. Okay, great. We parted. They moved out. We put in Party. What do they call it? Party City. Party City. Thank you. Mm-hmm. They're responsible for the Halloween stores that pop up, the seasonal stores too.
Okay. Yeah.
So got it. They just sent me $25,000 to take that spot for 90 days. Mm-hmm. So it's great. So now I don't go dark. And during this period where you got the skeletons and the pumpkins and whatever, the candy and the wigs, they're all hanging out of the store right now and the flashing lights. I guess they must have attracted the lumber liquidators. Have you ever heard of them? I have. So we just signed a lease with them. So it's just you got to stay on your feet. So I went from Christian Lifeway to Party City Halloween pop-up store to now I think it's going to be a 7-year lease. It's definitely a 5-year lease. We're talking about a 7-year lease, lumber liquidator. And they're moving in. So it's like, now I got a tenant for at least 5 years, has some really good credit. And, I don't have to do anything. Again, they're going to pay the taxes, they're going to pay the insurance, and they're going to fix it up.
What are the expectations as far as build out, tenant improvements? That particular deal hit on their own?
At that particular deal, they got $5 a square foot, and I think it's 8,000 square feet. Mm-hmm. So what was that, $40,000? Which is actually, I got a lot more money from the Christian store when they bought out their lease. But yeah, those are some of the things you have to worry about. But along with lumber liquidators, since it's a national name, and it's a good national name, and it's a good traffic driver, you get this cap rate compression. So in multifamily, we would call that repositioning. So in the retail shopping center business, in a way, we just repositioned. We got a stronger tenant, stronger name, better quality, cap rate compression. We bought the deal at like an 8.5 cap. I think it could easily trade at a 7 cap. They're paying more rent than the Christian store, and it's a fresh new lease, fresh new life. So you just got to roll with it. You lose tenants. Hopefully, you don't lose too many.
What were the primary reasons that might have traded at an 8.5 cap versus maybe you being able to turn around and sell today? I know you filled a few vacancies, but from an 8.5 to a 7 cap when everyone's chasing, right?
Great case study for us too in College Station, because we bought it at approximately, there was a 30% vacancy, and I think your listeners, it's a higher quality real estate listener, investor. When a company gets to a point where they transition themselves from this particular person that sold it to us, this firm that sold it to us, they were the C-class operator of 100,000 square foot shopping centers. And they transitioned into knocking some of their stuff down and building Class A shopping centers. So they just wanted to move this out the back door. No one was paying attention to it. It's off in College Station, like 90 miles away from Houston. So they just moved it, and I'm sure they made money on the deal too. But it's not alien to pick up an 8.5 cap rate right now in the retail business, nor is it alien to buy a 7 cap if you have the right names and the right quality and the right credit in place. Yeah.
So what's the long-term business plan as far as expansion? Is it a Houston and immediate surrounding areas as far as the retail is concerned, or is this a Texas-wide plan, or is it multiple state plan?
When I owned all that housing that we talked about earlier, I could drive to everything. And that's just the way you build that apartment business and the housing business. But when I got involved in the triple net leasing business, I have at least a dozen shopping centers from Wyoming to Colorado to Arizona, of course here in Texas and a few other states that aren't coming to me right now. There is around 1 million square feet here, but I'm in probably, if people go to my website later, I'm in probably, 8 or 10 different states. So wherever the deals are, wherever you feel like you can get the right management in place, the right leasing agent in place. Of course, we all know there's plenty of money out there and there's not enough deals. So cap rates, good names, a little vacancy, give me some extra land, and I'll be on a plane tomorrow.
And we're the same way. We're in like 13 different states, so we'll go wherever the deal is. Give me the deals. We're there. Airplane. That's what airplanes are for, right?
No, I'm sorry. Are you a deal junkie too?
That's it, man. That's it. In fact, I'm about to head down to Texas for a deal. We've gotten the contract right now. So my first foray into Texas as far as the mobile home park space is concerned. So
great. Yeah, I know it's on fire.
That would be the 14th state, which is crazy,
Wow.
But go to where the deals are. Go to where the deals are. So I want to switch gears a little bit if we could here, and we've covered a lot of great ground. Now I want to enter into what I like to call the lightning round, and this is where we have basically 6 short, very concise questions, looking for 6 short answers. And so let's roll with it if you're ready.
Sure.
All right. First one.
Should I stand up? Do I need my Jim Crane? Do I need my booyah bell?
You can do whatever you like. Whatever feels good, man. Whatever feels good. Biggest fear, what is it?
Biggest fear. Oof. I don't have cash flow.
All righty. I love it. One biggest regret.
I didn't buy enough real estate during the downturn.
I have that one too. Yeah. Outside the daily work grind, what do you do to decompress?
I have like a 3-hour morning routine, from meditation to foam rolling to exercising. I told you I'm climbing the 7 peaks of the world, so I'm staying in shape. Just a lot of quiet time in the morning.
Okay. The one thing that you can't live without?
I can't live without the chase, the love of going after the deal, the aha, the figuring out, this one just might work.
Yeah, no, I love it.
Yeah.
Last one here. What would your backup plan be if one day you woke up and you just you weren't in love with the chase, the real estate game anymore, and what would you do with your life? I mean, what would keep your days occupied?
Oh, I would just go travel infinitely. And I spend probably 3 or 4 months out of the country anyway, and there's still not enough time to go see everything there is out there.
So let's talk about the managing of your business, and as you go climb these various peaks throughout the world, and being away for weeks at a time during each one of these. This isn't like, hey, I'm going to jump on the plane over the weekend. Maybe Mount Rainier was maybe only a 5-day there, and climb back. But I mean, a lot of these other peaks are across the entirely across the world, and so like it's a multi-week trek. Sometimes probably more than a month that you'll be away at a time. How does your business stay intact?
Okay, so first of all, how we all have our groups. I have an adventure group, and it's got around 15 real estate buddies in it. It's called the 10X Adventure Club. So we usually go away together. So we turn it into a mastermind. And before we know it, we're really doing deals with each other, and we're making things happen. Secondly, I just got back from Russia. We were online the whole entire time as we were climbing this mountain called Mount Elbrus, which is 18,000 feet high. The whole time. So we didn't really miss a beat. We all have our offices, and I think when we say our offices, it's just like 1 or 2 or 3 people that we can rely on. And I'm really only doing real estate that's triple net. So there's no emergency that needs to be solved, in 1 hour when it comes to the stuff that I'm buying. It's really up to the tenant. It's like a leased car that drove off the lot. Yeah. No, I got it. I think I just made the connection between you and I, Danny Newberry. How do you know that? Danny and I are very good friends, and that's right. I told him this morning, like, Danny's in Memphis, Tennessee this morning, flying to Michigan, checking out all his deals. And Danny and I do this together. We hike all over the world. And quite frankly, Danny and I have done at least 12 to 18 transactions with each other. We've made a lot of money with each other. That's great. Yeah. He's a good guy. Good guy. I've never met him in person, but I've talked to him many times, had him on the show a few different times over the years. So good guy. That's great. Yeah. Well, awesome, Alan. So now I'd like to roll into the, where we round out the show. And this is what I like to call the golden nugget segment. Look, I for some reason, I think about Brian Tracy back in the day. And Brian Tracy would say something like, most people fail, like 99% of people fail immediately. And it's really because they just don't do what they want to do. They don't actually take the effort so they don't take action. So, as cliche as it sounds, if you want to grow your business, you want to take your business to the next level, you have to take action, actually do it, and create a plan and follow it. You just have to grow. It's like the whole Tony Robbins thing. If you're not growing, you're dying. You can't stand still. So I know you've got 2 websites, so I'll just repeat them one more time. Appreciate it. .com, and then also your company website, which is Great Partners. That's GR8. .com. And Alan, that's all we have, my friend. It's been a lot of fun. I enjoyed it. It was fun. Really appreciate you coming on the show. And thank you guys, each and every one of you, for tuning into this week's show. And until we meet again next week, this is your host, Kevin Butt, wishing you huge success. You take care.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com, and we'll see you next Monday morning.